Most people plan their retirement date around a birthday, or a work anniversary, or just a round number that feels satisfying, like the 1st of January, or the day they turn 65. And on paper, that seems reasonable. You've worked 30, 40 years. You've earned the right to walk out whenever you want. But here's what almost nobody tells you before they make that decision. The month you choose to retire can quietly cost you tens of thousands of dollars. Not because you did anything wrong, not because the market crashed, but because of a handful of financial mechanisms that only activate depending on the calendar date you stop working. And once that date passes, there is no undoing it. You can't call the Social Security Administration in March and ask them to pretend you retired in September instead. The window closes the moment you sign the paperwork. So today, we're going to walk through exactly why timing matters more than almost any other single decision you'll make in retirement planning, using real numbers, real thresholds, and real examples of what happens when people get this wrong. By the end, you'll understand why financial advisors who specialize in this topic will tell you, in private, that the date on the calendar is sometimes worth more than an extra decade of diligent saving. Let's start with the most misunderstood piece of this puzzle: Social Security timing. Most Americans know, at least vaguely, that claiming early reduces your monthly check and waiting increases it. What most people don't understand is how granular that calculation actually is. Social Security doesn't just adjust your benefit based on the year you claim. It adjusts based on the month. Every single month you wait past your minimum eligibility age of 62, up until age 70, increases your monthly benefit by a small but very real percentage. It's not a smooth curve either. The increase accelerates the closer you get to your full retirement age, and then continues climbing afterward through what's called delayed retirement credits. Here's what that looks like in practice. If your full retirement age is 67 and you decide to claim at 62 instead, your monthly benefit could be reduced by around 30% permanently. Not for a year, not until you catch up. Permanently for the rest of your life. On the other end, if you delay past 67 all the way to 70, your benefit grows by roughly 8% per year, compounding. That's not a rounding error. Over a 20 or 25-year retirement, the gap between claiming at 62 versus 70 can total more than $100,000 in lifetime benefits for a single person, and often much more for a married couple coordinating their two benefit streams. Now here's where the month, not just the year, becomes critical. Say you're planning to retire in December, right at the end of the year, thinking you'll close out on a clean, tidy date. That single choice can push a chunk of income into a tax year you didn't fully account for. If you've been working the entire year up to that point, your December paycheck, plus any bonus, plus any final commission, plus your first months of Social Security if you start claiming immediately, all lands inside the same 12-month tax window. That combination can bump you into a higher marginal tax bracket than you expected. Not because you earned dramatically more money over the year, but because everything hit at once instead of being spread out. Compare that to retiring in January instead. Suddenly, your final year of full-time work income is isolated in its own tax year. Your retirement income starts fresh in a new calendar year, often at a lower total, and you have far more control over how much taxable income shows up in that first partial year of retirement. This is one of the simplest and most overlooked levers in the entire process, and it costs people real money every single year because nobody explains it to them in plain language before they've already put in their notice. But Social Security taxation and delayed credits are only the beginning. The next mechanism most people have never heard of, until it costs them money, is something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is, without exaggeration, one of the most expensive and least understood surprises in the entire retirement system. Here's how it works. Once you're on Medicare, your monthly premium isn't a flat rate for everyone. If your income crosses certain thresholds, you pay significantly more, sometimes more than triple the standard premium. In 2026, the standard Medicare Part B premium sits at just over $200 a month. But once your income crosses roughly $109,000 for a single filer, or $218,000 for a married couple filing jointly, the surcharges begin, and they escalate in tiers. At the highest tier, retirees are paying close to $690 a month for the exact same Medicare coverage as someone paying $200. Now here's the part that catches people completely off guard. IRMAA doesn't look at your income this year. It looks at your income from 2 years ago. That's called the lookback period. So the Medicare premium you pay in 2026 is based on your tax return from 2024. Which means, if you retired in the middle of 2024, had one final full paycheck, maybe cashed out unused vacation time, maybe took a lump sum bonus, maybe did a Roth conversion that year, because your advisor told you it was a smart long-term move, all of that income compounds together on that one tax return. And 2 years later, when you finally enroll in Medicare, you get a letter in the mail informing you that your premium is going to be several $100s a month higher than you expected, because of a decision you made 2 full years earlier that you probably don't even remember clearly. And here's the cruelest part of the IRMAA system. It doesn't work like a normal gradual tax bracket. It's what's called a cliff. If your income lands $1 over the threshold, you don't pay the surcharge on just that $1. You pay the surcharge on your entire premium for the entire year. A retiree who reports exactly $109,000 in income pays the standard rate. A retiree who reports $109,001 in income jumps to the next tier entirely, adding close to $1,000 a year in extra Medicare costs for one extra dollar of reported income. That single dollar, timed wrong at the wrong point in the calendar, can cost a retired couple with both spouses on Medicare nearly $2,000 a year, every year, until their income drops back down, or the following year's return shows a lower figure. This is why the month and year you retire in relation to your Medicare enrollment date is not a minor administrative detail. It's a financial decision with a 2-year delayed fuse attached to it. Retire in a year where your income is unusually high because of severance, bonuses, or a Roth conversion. And you may not feel the consequence until 2 years later, when you're already deep into retirement and least prepared to absorb a surprise expense. The good news is that this is almost entirely preventable, if you know about it in advance. There's a specific form, SSA-44, that allows you to request a recalculation of your IRMAA premium if you've had what's called a life-changing event, and retirement itself qualifies as one of those events. If you retire and your income drops significantly compared to the year the IRMAA calculation is based on, you can file this form and ask Social Security to use your current, lower income instead of the outdated 2-year-old figure. Most people never learn this form exists until they've already paid the higher premium for months, sometimes for an entire year, simply because nobody told them at the moment it mattered. Let's talk about another piece of this puzzle that almost never gets discussed outside of financial planning circles: the golden window. This refers to the 2 or 3 years right before you enroll in Medicare, typically somewhere between age 63 and 65, when your income has usually dropped because you're no longer earning a full-time salary, but you haven't yet triggered required minimum distributions from your retirement accounts, and you haven't yet enrolled in Medicare. So IRMAA isn't watching you yet. This window is often the single best opportunity in your entire financial life to do things like Roth conversions, moving money from a traditional tax-deferred retirement account into a Roth account, paying the tax now while you're likely in a lower tax bracket than you'll be in later, when required distributions and Social Security income combine to push you higher. But here's the catch. If you retire at the wrong time, or if you don't understand this window exists, you can accidentally miss it entirely. Retire too late, and you might not have that low income gap at all, because you're still drawing a large paycheck right up until Medicare kicks in. Retire and immediately convert too aggressively, without realizing the conversion itself creates the exact taxable income that will trigger IRMAA 2 years later, and you can undo the entire benefit you were trying to create. This is precisely why so many financial advisors describe retirement timing not as a single decision, but as a multi-year sequencing puzzle, where the order of operations matters just as much as the decisions themselves. Now let's bring this back to something more immediate and practical. Required minimum distributions, often shortened to RMDs. Once you reach a certain age, currently 73 for most people under current law, the government requires you to start withdrawing a minimum amount from your traditional retirement accounts every year, whether you need the money or not. These withdrawals count as taxable income. If your retirement date lines up poorly with the year you turn 73, you can end up in a situation where your final paycheck, your first Social Security payments, and your very first mandatory retirement account withdrawal all land in the same tax year. That's 3 separate income streams, all taxable, all converging at once, in a year you didn't plan around carefully. The result is often a tax bill that shocks people who assumed retirement would automatically mean lower taxes. Sometimes it does, but only if the timing is managed deliberately. Here's a real-world style example to make this concrete. Picture 2 people, both named, for simplicity, Retiree A and Retiree B. Both have identical savings, both have identical Social Security benefits, both have identical pensions. The only difference between them is the month they chose to retire. Retiree A retires in December, right at the very end of the year, immediately starts drawing Social Security the following month, and had a strong final quarter at work with bonuses and unused vacation payout landing in that same December paycheck. Retiree B retires in January instead, delays Social Security by just 11 months to hit a slightly higher benefit tier, and spreads their final work income and their first retirement income across 2 completely separate tax years. Over just the first 3 years of retirement, Retiree A ends up paying more in combined income tax and Medicare IRMAA surcharges, largely because of how their income clustered together, while Retiree B, with the exact same total lifetime resources, keeps more of their money simply because the calendar worked in their favor instead of against them. Multiply small annual differences like this across a 20 or 25-year retirement, and you're talking about a gap that can realistically exceed $50,000 to $100,000, not from earning more, not from investing better, but purely from timing. There's one more layer to this that deserves attention: spousal coordination. If you're married, your retirement date doesn't just affect your own benefits, it affects your spouse's as well, especially when it comes to Social Security, spousal benefits, survivor benefits, and the overall household tax bracket are all influenced by when each partner decides to stop working and when each partner decides to start claiming. Couples who retire and claim benefits without coordinating the timing between the two of them frequently leave money on the table, sometimes significant amounts, because they treated 2 intertwined financial lives as 2 separate, independent decisions. For example, in many households, it makes sense for the lower-earning spouse to claim their own benefit earlier, while the higher-earning spouse delays as long as possible, because the higher earner's benefit is the one that eventually becomes the survivor benefit if one spouse passes away first. Get this sequencing wrong, and the surviving spouse can end up locked into a permanently lower survivor benefit for the rest of their life, simply because the couple didn't think through which benefit they were protecting when they made their individual retirement decisions. So, what should you actually do with all of this information? The goal here isn't to scare you away from retiring, and it's not to suggest that there's one universally correct month for everyone to retire in. The truth is more useful than that. The right retirement date depends on your specific income sources, your specific tax situation, your specific age relative to Medicare enrollment, and required minimum distributions, and whether you're single or coordinating with a spouse. But the mistake almost everyone makes is not asking these questions at all. They pick a date based on sentiment, a birthday, an anniversary, a symbolic milestone, and they never run the numbers on how that date interacts with tax brackets, with the Social Security lookback rules, with the IRMAA 2-year delay, with required minimum distribution age triggers, and with spousal benefit sequencing. If there's one single action step to take away from everything we've just covered, it's this. Before you set a final retirement date, sit down, ideally 18 to 24 months in advance, and map out exactly what your income will look like in the calendar year you retire, and in the 2 years immediately following. Look specifically at whether your final paycheck, bonuses, unused vacation payouts, and any one-time withdrawals are going to land in the same tax year as your first Social Security payments. Look at whether that same year is going to become the look-back year for your Medicare IRMAA calculation 2 years later. And if you're within a few years of turning 73, check how required minimum distributions are going to interact with everything else. None of this requires a finance degree to understand once it's laid out. It simply requires knowing that these mechanisms exist in the first place, which is exactly why so many retirees find out about them only after the fact, when a letter arrives in the mail informing them of a premium they didn't expect, or a tax bill that's larger than they planned for. The system isn't designed to hide this information from you, but it also isn't designed to explain it clearly either. Social Security's own materials focus on your monthly benefit amount. Medicare's enrollment materials focus on coverage options. Nobody sends you a single unified letter explaining how your retirement month interacts with all of these systems simultaneously. That's the gap this channel exists to fill, breaking down exactly how these overlapping rules affect real people, in plain language, with real numbers. So you can make decisions with your eyes open instead of learning the hard way, 2 years too late, when the bill finally arrives. There's another timing trap that catches an enormous number of early retirees off guard, and it has nothing to do with Social Security or Medicare directly. It has to do with the gap between when you stop working and when Medicare actually begins. Medicare eligibility starts at 65, but a huge number of people retire well before that, at 62, 63, 64, often because they're simply ready to stop, or because a job ends unexpectedly, or because health issues push the decision earlier than planned. If you retire before 65, you need health insurance from somewhere, and for most people that means the Affordable Care Act marketplace. Here's where timing becomes critical again. ACA subsidies are based on your household income for the year you're covered, estimated in advance, then reconciled against your actual tax return afterward. If you retire in, say, March, but your income for the full year still includes 2.5 months of full salary, plus any severance, plus any accrued bonus, your estimated income for ACA purposes can end up much higher than your actual retirement year income going forward. That can either disqualify you from subsidies you would have otherwise received, or worse, you can receive subsidies based on an estimate. Have your real income come in higher than expected because of that same severance and bonus income, and then owe money back to the government when you file your taxes the following spring, because you were subsidized based on a number that didn't match reality. The reverse can also happen. Retire earlier in the year, in January or February, and your household income for that calendar year might genuinely be low enough to qualify for substantial ACA subsidies, sometimes reducing a marketplace health insurance premium by hundreds of dollars a month, simply because your total taxable income for that 12-month period reflects a partial year of work followed by many months of little to no income at all. People who retire in December, by contrast, often carry a nearly full year of high salary income into their ACA application, disqualifying themselves from savings they might have received if they'd simply retired 2 or 3 months earlier in the same year. This is yet another example of the same underlying pattern we keep coming back to throughout this video. It's never really about the total amount of money you have saved or how well you've invested over the decades. It's about how that money and that income get organized across specific calendar years and specific tax filing periods, in relation to specific thresholds that the government has built into Social Security, Medicare, and the ACA marketplace. 3 completely different government systems, 3 completely different sets of rules, and all 3 of them are quietly watching the exact same thing: which 12-month window your income lands in. Let's talk about one more scenario that illustrates just how much money can be sitting on the table because of pure timing, completely separate from investment performance or savings discipline. Consider someone who has built a healthy nest egg in a traditional 401k or IRA, meaning the money was contributed before taxes, and taxes are owed whenever it's withdrawn. If this person retires at 62 but delays withdrawing from that account, living instead off savings, a small pension, or part-time consulting income, they may have several years, sometimes 5, 6, even 7 years, where their taxable income is unusually low. Financial planners often call this the tax bracket valley, the dip in income between leaving full-time work and being forced to take required minimum distributions or claim Social Security. During this valley, someone can strategically convert portions of their traditional retirement account into a Roth account, paying taxes at today's low rate instead of a potentially higher rate later, when Social Security, a pension, and mandatory withdrawals are all layered on top of each other simultaneously. But if that same person retires just 1 or 2 years later than they could have, or claims Social Security immediately instead of waiting, that valley shrinks or disappears entirely. The opportunity to convert money at a low tax rate closes, sometimes permanently, because once required minimum distributions begin, or once Social Security income is layered in, the room available in the lower tax brackets simply isn't there anymore. This is why some financial planners will tell you, somewhat counterintuitively, that retiring slightly earlier than planned, even by a single year, can sometimes save a household more in lifetime taxes than working that extra year would have earned them in salary. It sounds backwards until you see the math laid out year by year, but it's a direct consequence of exactly the same timing principles we've been walking through this entire video. None of this is meant to suggest that you need to become a tax strategist overnight, or that there's some perfect, universal formula that applies identically to every single retiree in the country. Your situation depends on your specific accounts, your specific state of residence, whether you're single or married, and dozens of smaller variables. But the overarching lesson is consistent no matter who you are. Retirement is not a single event that happens on one day. It's the beginning of a multi-year sequence of income decisions, each one interacting with rules that were written by different government agencies at different points in time, with almost no coordination between them. Social Security doesn't consider what Medicare is going to do to you 2 years later. Medicare doesn't consider what the ACA marketplace would have offered you if you'd retired 2 months earlier. And the IRS doesn't send you a warning letter before you make a decision that locks in a higher tax bracket for the following year. Every one of these systems operates independently, and it's entirely up to you, or whoever is helping you plan, to notice how they overlap. If this was useful, the best next step is to look specifically at your own numbers. Pull up your most recent Social Security statement Check your current tax bracket and think honestly about which month of the year your income naturally slows down or ends. That single piece of information is often the starting point for the entire conversation about when to actually walk away from work. We'll be covering more of these hidden mechanisms in upcoming videos, including exactly how spousal benefit coordination works in detail and which states will tax your Social Security income even after you've stopped working entirely. Subscribe if you want to stay ahead of these rules before they cost you money instead of after.